Monetary policy is the primary engine of modern global finance, and the Federal Reserve, the Fed, serves as its conductor. Since the end of the great financial crisis, and particularly following the post-pandemic inflationary surge, the world has watched the Federal Open Market Committee, FOMC, meetings with bated breath. The most critical transition period in a monetary cycle is not the hike, nor the cut, but the pause. A Fed pause occurs when the central bank decides to stop raising the federal funds rate FFR to assess the economic impact of previous hikes, yet is not ready to lower rates. It is a period of waiting and seeing. While it may sound passive, the pause is often the most volatile and psychologically complex period for markets. It represents the inflection point between a tightening cycle, fighting inflation, and an easing cycle, stimulating growth. This analysis explores the multifaceted impact of a Fed pause across the macroeconomy, specific asset classes, and the global financial system. To understand why the Fed pauses, one must understand the concept of long and variable lags, a term coined by economist Milton Friedman. Monetary policy does not work instantly. When the Fed raises rates today, the full economic impact, cooling demand, slowing hearing, and reducing inflation, may not be felt for 12 to 18 months. If the Fed continues to hike until inflation hits 2%, they will likely have over-tightened, crashing the economy into a deep recession because the hikes from a year ago are still working through the system. The pause is essentially a calibration tool. It allows the central bank to observe the lagged effects of their policy without adding new restrictive pressure. During a pause, the nominal interest rate, the number the Fed announces, stays flat. However, the real interest rate, nominal rate minus inflation, can actually continue to tighten. Consider this scenario. The Fed holds rates at 5.5%. Inflation falls from 4% to 3%. Real rate increases from 1.5% to 2.5%. Therefore, a pause is not necessarily neutral. As inflation falls while the Fed holds steady, monetary policy technically becomes more restrictive naturally. This phenomenon puts passive pressure on the economy even if the Fed does nothing, often surprising analysts who expect financial conditions to ease immediately. The most immediate question for investors is, what do I buy? The answer depends heavily on why the Fed is pausing. Is it a bullish pause, soft landing achieved, or a bearish pause, something broke? Historically, stocks tend to rally initially when a pause is announced. This is known as a relief rally. The market reprices the removal of the immediate threat of higher borrowing costs. Valuation expansion. Stock prices are theoretically the present value of future cash flows. When interest rates stop rising, the discount rate used to value those cash flows stabilizes. This usually leads to PE, price to earnings, multiple expansion. Sector rotation. Growth and tech. High-duration assets, companies with earnings far in the future, like technology, typically benefit most from a pause. Their valuations are most sensitive to interest rates. Defensives. Utilities and consumer staples may lag in the initial rally, but become critical if the pause transitions into a recession fear. Financials. Banks often struggle during a pause if the yield curve remains inverted, short-term rates higher than long-term rates, which squeezes their profit margins. The earnings risk. While valuations may improve, the risk shifts to earnings. If the cumulative effect of past hikes slows the economy too much, corporate revenues drop. A pause often marks the moment the market stops worrying about the Fed and starts worrying about the consumer. For bond investors, the Fed pause is the golden hour. Peak yields. A pause typically signals that bond yields have peaked. Since bond prices and yields move inversely, buying bonds at the start of a pause allows investors to lock in high coupon payments and enjoy capital appreciation as market yields eventually fall in anticipation of future rate cuts. The yield curve. A pause is often where the yield curve begins to steepen. Traders begin to buy long-term debt, anticipating that the next move is a cut. This anticipation drives down long-term yields, potentially uninverting the curve. Gold. Gold is a non-yielding asset. When interest rates are high, gold is less attractive compared to treasuries. However, when the Fed pauses, the opportunity cost of holding gold stabilizes. If the pause weakens the US dollar (USD), gold typically enters a bull market. Oil. Crude oil is highly sensitive to economic growth. If the pause is interpreted as the Fed has managed a soft landing, oil may rally on demand hopes. If the pause is seen as the economy is stalling, oil often sells off. Real estate is the most interest rate sensitive sector, but it reacts slowly. Residential. Mortgage rates do not track the Fed funds rate. 1. They track the 10-year Treasury yield. During a pause, volatility in the bond market decreases, which can help stabilize mortgage rates. However, prices rarely rebound immediately due to the affordability crisis created by the previous hiking cycle. Commercial real estate (CRE). This sector faces high risk during a pause. Many commercial loans differ from fixed-rate residential mortgages. They are often floating rate or require refinancing every few years. Even if the Fed pauses, rates remain high. Refinancing a building at 7% that was previously financed at 3% can destroy the asset's equity value. The US dollar (USD) is the global reserve currency, and the Fed is effectively the world's central bank. The USD usually performs well in two extremes. Extreme US growth. Rates are high, attracting foreign capital. Global recession. Investors flee to safety. USD. A Fed pause typically lands in the middle of the smile, which is often bearish for the dollar. If the Fed stops hiking while other central banks, like the ECB or Bank of England, are still raising rates to fight their own inflation, the interest rate differential shifts against the dollar, causing it to weaken. A Fed pause is a lifeline for emerging markets, Vietnam, Brazil, Indonesia, etc. Debt servicing. Many nations and corporations borrow in USD. When the Fed hikes, the dollar strengthens, making that debt more expensive to pay back. A pause halts this cycle, reducing the risk of sovereign defaults. Capital flows. When U.S. rates are stable, risk appetite returns. Investors search for yield outside the U.S., leading to capital inflows back into emerging markets. History doesn't repeat, but it rhymes. Analyzing past pauses gives us a roadmap. The 1990 41995 pause, the soft landing. Context: the Fed doubled rates in 12 months. Outcome: they paused in early 1995. The economy slowed but did not crash. Market reaction: this was the launchpad for the massive late 90s dot-com bull market. Stocks ripped higher because the economy remained strong while rates stabilized. Context: the Fed hiked rates to 5.25% and paused in June 2006. They held rates there for over a year. Outcome: the housing market began to crack under the surface during the pause. The stock market initially rallied, reaching new highs, oblivious to the rotting credit foundations. Lesson: a pause can create a false sense of security. The pivot to cuts only came when the global financial crisis was already underway. Context: the Fed tried to normalize rates, but the stock market crashed nearly 20% in late 2018. Outcome: Fed Chair Powell famously pivoted in early 2019, pausing and then cutting rates. Market reaction: this led to a massive rally in 2019, proving that if the Fed pauses before a recession hits, assets can perform exceptionally well. While Wall Street focuses on charts, the Fed pause impacts Main Street through credit and employment. Savings accounts. During a pause, high-yield savings accounts HYSA and money market funds offer their peak returns. Savers finally get rewarded. Credit cards and auto loans. These rates are usually sticky. Even if the Fed pauses, consumer borrowing costs remain at multi-year highs. This leads to a gradual erosion of consumer discretionary spending. Employment is always the last domino to fall. Companies hoard labor as long as possible. Usually, the unemployment rate only begins to tick up meaningfully during the pause or shortly after the first rate cut. During a pause, we typically see a freeze in hiring rather than mass layoffs. The job openings, JOLTS, data declines, wage growth slows, and worker leverage decreases. The modern Fed has introduced a specific nuance to the pause, the concept of higher for longer. In previous cycles, the market expected a V-shape, hike fast, then cut fast. However, if inflation is structural due to deglobalization, demographics, or energy transitions, the Fed may pause and hold rates at a restrictive level for years, not months. The danger of the plateau. If the Fed holds rates at 5% for 2 years, the refinancing wall, corporate bonds issued during the cheap money era, 2022-021, will mature. Companies will have to refinance debt at double or triple the cost. This can lead to a wave of zombie company bankruptcies during the pause. Fiscal dominance. Higher rates mean the U.S. government pays more interest on its national debt. A long pause exacerbates government deficits, potentially leading to credit rating downgrades for the sovereign itself. Given the complexity, how should portfolios be positioned? A popular strategy during a pause is the barbell. End one safety, short-term treasuries or cash. These yield high returns with zero risk, taking advantage of the pause rates. End two growth, high-quality tech stocks with strong balance sheets, cash-rich, low debt. These companies are immune to high interest rates because they don't need to borrow, but they benefit from the relief rally. A pause is not the time to buy junk bonds or distressed companies. As the economy slows, the lag effect, default risks rise. Investors flock to quality, companies with consistent earnings and low leverage. As the pause matures, investors slowly move from owning cash bills to owning longer-term bonds, notes bonds, to capture the price appreciation when the inevitable rate cuts finally arrive. A Federal Reserve rate pause is a deceptive calm. On the surface, it looks like stability. Rates stop moving and the central bank goes quiet. However, beneath the surface, the tectonic plates of the economy are shifting. The pause is the period where the bill comes due for the previous tightening. It is the testing ground where the market discovers whether the economy is robust enough to handle high rates, soft landing, or if the foundations will crack, hard landing. For investors, the pause is a signal to stop focusing on inflation and start focusing on growth. The narrative shifts from how high will rates go to how much will earnings fall. History teaches us that the pause is usually a positive environment for stocks and bonds in the short term, fueled by relief. But it is also a period of maximum vigilance. The longer the Fed pauses at a restrictive level, the higher the probability of an accident in the financial plumbing. Understanding the nuance of the pause, distinguishing between a hawkish pause, ready to hike again, and a dovish pause, preparing to cut, is the key to navigating the transition from a bear market to the next bull cycle.